Hello and welcome back to London on this crisp December's day. Behind me you can just about make out the Tower of London, but now let's get down to business. I've been speaking to Craig Earnham from ALPARI about the last Bank of England and ECB meetings of the year. Right, so let's talk about the two central bank meetings. Let's face it, neither was that interesting, but at least we've got the speech from Draghi to talk about. In terms of the growth forecasts, they were downgraded for next year, but slightly more bullish in the longer term in 2014.
Yeah, I mean, we should really get used to seeing this. I mean, they've always been bullish for a long time now. If you look back to the previous couple of years, we always see slower growth in the short term, and it starts to pick up in the medium and long term, and the longer term growth forecast is always much more optimistic than anyone else in the market really sees. I mean, already we've got the second half of next year when we start to expect to see recovery, and in 2014 I think it was up to 2.2% growth rate. I mean, if you look at the Eurozone at the moment, I can't see anyone really seeing the 2014 growing by 2.2%. I mean, next year alone, I think a zero growth rate is probably more realistic. So that jump up to 2.2% seems, well, just crazy to me at the moment, to be honest.
So unrealistic rather than bullish?
Completely unrealistic, in my opinion.
Do you anticipate any change in monetary policy any time in the near future?
It's very difficult to say because some things he says suggest that maybe we will see it. They said there was a heavy discussion today about whether to change the interest rates, whether to lower the interest rates. You've also got the fact that the inflation figure for next year, the forecast for next year was very low, which suggests there's plenty of room for further interest rate cuts. But on the other hand, they said they don't really intervene and don't want to encourage governments to move away from these reforms, which they've already started. So again, it doesn't really, to me at this moment in time, it doesn't really look like we are going to see an interest rate cut. And if we do, if anything, it's probably going to be the latter half for next year once they start to realise that these very, like I say, unrealistic, optimistic growth forecasts aren't really coming to fruition.
It's not going to do that much though, is it? It's 0.75 already. How much difference can a rate cut make?
Very little, actually. I mean, if you look at it at the moment, what's going to impact growth more in the Eurozone is going to be these further austerity cuts in the countries, and the fact that people just aren't optimistic. So that's affecting consumer spending, it's impacting business confidence, and these are going to have a much larger impact than any kind of 0.25% rate cut that the ECB could produce.
The Bank of England, again, didn't do anything. What's your feeling with the Bank of England? Because there was a time when everyone was anticipating more QE, but that speculation has now cooled. Do you think that we will see some in 2013?
I think it's going to be quite difficult to tell at this moment in time. I mean, like you say, a few months ago when you spoke about the asset purchase programme expiring in November, everyone was so sure that there was going to be more QE. Everyone was sure there was going to be £50 billion more of QE. Whereas when it got to the end of October, the start of November, people realised, hold on, there's not going to be any QE at all. We've seen that 1% growth rate for the third quarter, and people all of a sudden a lot more optimistic, and we started to see this inflation figure started to edge upwards again. So, but now, obviously, it was no surprise that we didn't see any extension today. The first quarter of next year, I think, is also maybe a little bit too optimistic. It's going to take seeing that GDP figure we're expecting, maybe even a small contraction at the start for the fourth quarter of this year, that it might actually start to encourage them now to undergo further QE. But again, I think it's about questioning whether it's actually going to make any real difference. I mean, we've already got MPC members saying at the moment that is it actually making any improvements to the economy, or are we just driving up inflation without having the benefit of improved growth? I mean, we can't honestly say now that it's the reason for the 1% growth rate that we actually saw in the third quarter was anything to do with that asset purchase programme. It was clearly the Olympics and the Jubilee in the third quarter, which is why we're expecting a fall all the way back to around maybe 0.1% growth in the fourth quarter. So it's about weighing off whether we think it's worth it in the long term, given the fact that inflation is starting to creep higher again. But in my opinion, in the first quarter of next year, I don't really think we'll see any more. Yeah,
before we get to next year, we've obviously got the rest of December. So what's going to drive investor sentiment? Is it simply the fiscal cliff?
Exactly. I mean, I think the fiscal cliff has driven sentiment for the last month as well. And to be honest, I think sentiment overall for the next few weeks is going to be relatively low. There's going to be obviously a lot of talk coming out from Congress and from President Barack Obama. We've seen a lot of it already. Very optimistic from Barack Obama, very pessimistic from the Republicans. And to be honest, I think that's what's going to drive the markets over the next few weeks. I think we're going to see choppy markets. I don't really think we're going to see them heading in one way or another. And it's going to be the end of the year when we're going to see a definitive move. And I think assuming that we do actually see this fiscal cliff resolved, or at least the can kick further down the road at the end of the year, that's when we'll start to see markets start to push higher again. But there is always the danger that we're not actually going to see anything resolved. And when we saw Tim Gardner, the Treasury Secretary, say last night that they were willing to go over the fiscal cliff if the Republicans wouldn't agree to the tax hike on the top 2%. So if we do see him fall over the cliff, then we could also see the stock markets and also the currency markets, especially the risk assets, also fall off a cliff at the end of the year if we do actually see this.
So about the key FX pair, euro dollar, it's currently above 130. Bearing in mind what you've just said, do you expect it to remain around that level?
Maybe in the short term. As we progress through the month, I think risk appetite is going to massively decrease. I mean, like I said, as we approach that fiscal cliff, there's always that increased chance that we are going to actually see us go over the edge of the fiscal cliff. And if we do go over the fiscal cliff, I think risk appetite is going to be shot altogether. And we've seen it with the US in the past. Last year with the debt ceiling, when they left it right up until the final hour of the final day and only resolved it when they absolutely had to. And I don't see any reason to believe why this is going to be any different. We've already seen a lack of negotiation so far. I don't think President Barack Obama's even met with the Republicans yet face to face to have a discussion. And this is a guy who said he wanted this all resolved by Christmas. I mean, I think we've got a lot of optimism there, but I really don't see anything being resolved by the end of the year. So I think as we progress through the month, I think risk appetite is just going to start to disappear more and more. So we may have already seen euro dollar peak this year.
Craig Earlham from ALPARI speaking to me there, and there's more interviews to come here on Duke's Copy TV, so stay tuned. But for now, goodbye.